Great. Welcome, everybody. My name is Greg Kizer, Senior Vice President at ITM. We're going to be presenting on quick tips for effective ILIT management. We're just going to give it a couple more minutes here as it looks like we have more people joining us. All right, we can go ahead and get started. Let's go to the next slide. So just a little bit about ITM. ITM, it stands for Insurance Trust Monitor. We've been around for over 20 years, and we are the nation leading provider for risk management solutions for trust-owned life insurance. We partner with over 300 banks and trustees. We manage over 20,000 life insurance trusts, and we perform everything from policy reviews to a full outsource administration and policy management solution for any corporate trustees managing a portfolio of life insurance trusts. And I should mention, we also don't market or sell insurance of any kind, so really remain conflict-free. With us on the call today is also our colleagues from Life Insurance Trust Company. So Life Insurance Trust Company is a sister company of ITM. And really working with corporate trustees for over 20 years managing their life insurance trusts, we found out that most corporate trustees do not like life insurance trusts. They present a lot of liability. There's a lot of costs associated with it. They're revenue neutral at best. And we created Life Insurance Trust Company to offer successor trustee services for any corporate trustee that no longer wants to serve as trustee for any perhaps non-meaningful ILIT relationship, or perhaps for their entire book of ILITs. And at Life Insurance Trust Company, we've really perfected the bulk transfer process and a model that allows trust officers, advisors, relationship managers to be attached to the account while Life Insurance Trust Company serves as trustee. And should any policy fund, those assets will then be passed back to the referring trust organization should there be a continuation of trust provisions. As I mentioned, we started this a little over 7 years ago, and Life Insurance Trust Company today is the largest corporate trustee for life insurance trusts, managing over 5,000 ILITs today in its short time span as a corporate trustee. Presenting on the call with me today, we have Tony McKillip, President of Life Insurance Trust Company. And we also have Amanda Einwechter, who's a new business manager at Life Insurance Trust Company.
Thank you, Greg. Glad to be here.
Sure. We'll cover the agenda next. So we'll just start off by just giving a background of kind of some trends in the TOLI marketplace today. And then we're going to jump into some management tips. And we have about 4 tips that we're going to provide you today. And we really got these from questions that were coming from our clients this year. And we saw a question arising more than once. And if that was the case, we put it on this agenda today. So the first thing we're going to be covering today regarding the tips is purchasing versus gifting a life insurance policy to an irrevocable life insurance trust. Then we'll get into dealing with an unresponsive grantor, how to handle that. We'll walk through trust fees, what other trust organizations are charging today for ILITs. And lastly, we'll cover the underlying investment component for variable life insurance. Jumping into the stats, and as I mentioned, at ITM, we manage over 20,000 life insurance trusts. We've been doing so for a long time. So we do have some interesting stats looking at our whole portfolio that we manage for our 300 plus clients. And the first trend that we're seeing is really the population of insureds is aging. More and more of these policies were taken out 10 years, 20 years ago versus brand new ones that we're seeing coming into trust. And for that reason, a typical ILIT portfolio, we see about a 6% attrition a year. There's more policies that are either paying out death benefits, or perhaps the grantor wants to surrender the policy, or the policy's lapsing, versus new business coming in. Now, with that said, I will say this year we have seen an uptick of new ILITs coming into trust, new policies coming into trust, and perhaps that's for some estate tax exemption planning with those estate tax sunset rules changing in 2026, and we see a number of advisors planning ahead for that and perhaps writing new ILITs for their clients. An ILIT trustee is responsible for 3 to 4 decades of trust and policy management. So that's the typical lifespan. If you're opening up a brand new ILIT, we see it takes about 3 to 4 decades of management before that death benefit pays out. And as the life insurance policies age, the issues around them tend to increase. The longer the life insurance policy is in force, the longer the time frame there is where perhaps those original projections are not being met, and now we perhaps have a policy risk issue. And the most common risk issue with trust-owned life insurance is really the funding of the policy. Is what you're paying in premium, is what you're filling that policy with gas in the tank, is that going to be enough to get us to our destination, which is typically what we like to see, less than 10% chance that the insured will be alive. 34% of all policies are high risk, so they do have that funding issue. And really what those policies warrant is remediation, doing a suitability update with your client. Is that original purpose for that policy still in place today? Can they pay more in premium to get that policy to carry out longer, well beyond life expectancy or perhaps maturity of the contract? If they can't pay more in premium, would a death benefit reduction make sense? Are they still healthy today, or do they have known health issues to the point where you're not concerned about the lapse in 10 years because of those health issues? So those policies really that are underfunded and have a high risk of lapsing really should be put into a path for remediation. So jumping into some key trustee duties, I'm going to let Tony McKillip, president at LITCO, since he sits in the chair and manages these ILITs himself, cover this slide.
Sure, thank you, Greg. Appreciate it. So kind of high level, some key trustee duties, include management of premiums. This includes sending out premium due notices, collecting the funds, sending the funds to the carrier in a timely manner, making sure that they're not received too early or too late on some of these guaranteed policies, because that can have a drastic impact on them. So it's really, and then in addition, it's calling and confirming with the carrier, confirming that they received it, policies in good force, good standing. You have current illustrations on file following that premium being made. Interaction with beneficiaries. This is something that a lot of corporate trustees of irrevocable life insurance overlook. It's important to keep the beneficiaries involved in the status of the policy, making sure you have their updated contact information, and then making them aware of any potential remediation issues. Address taxation issues. While most ILITs will not need a tax return, there are several circumstances that can trigger a tax return, and the trustees should be aware of these. If you have a policy loan, you have a policy that lapsed, life settlement, surrendering of a policy, closing of a trust due to the maturation of the policy. These are all things that have the potential to cause taxable events, and we just need to be very cognizant of that. And if tax returns are filed, it's really the trustee's duty to file those. And then management of trust assets. Management and proper disclosure to all pertinent parties of policy information is imperative. Everybody needs to be aware of what's going on. As Greg mentioned, if the funding isn't adequate, beneficiaries, grantors need to be aware of that. It's at any given time, a trustee should know exactly what's going on with that policy, how to remediate that policy, and effectively communicate that to the parties. So on the next slide, I'd like to take just a minute and talk about, some ILIT fiduciary risk. And these can really be categorized into legal, regulatory, and reputational risk. The first is legal issues. You have two kind of subsets here: trust management and policy management. A lot of corporate trustees overlook the importance of administering the policies and assets in the trust in accordance with the terms of the trust. And then also gift and crummy notices, making sure that these are handled properly, these are documented accordingly, it complies with the terms of the trust agreement. These are all pitfalls that can get trustees into big trouble. And then policy management, is the policy being properly funded? Are you aware of all remediation options? And have you communicated those to the parties of the trust? And then regulatory risk, obviously audits are increasingly, regulations are increasing, and audit regulatory requirements are increasing as well. Are policies being reviewed annually by qualified independent personnel? Do we actually know what's going on with those policies? Are all documents and reports relating to policies and trust management readily accessible? Can you back up everything that you've done as an ILIT trustee? And then reputational risk. If you take these on and you do a poor job, that a lot of times leads to, poor client experience, or there are actions that should have been taken that weren't, our grantors and beneficiary receiving the best value they can from these insurance assets. So a lot of reputational risk as well. The last thing you want, and I'll share a story a little bit later as to, a situation that kind of went bad with a variable policy, but you really don't want as a corporate trustee to mismanage this, even if you're doing a great job on the other assets that the clients have. You want to make sure you're effectively managing this, because it really is a client experience, and there's a lot of reputational risk associated with that.
Great overview. Thanks, Tony. I know another common theme that we're coming across, especially with advisors that are writing new ILITs.
Sure.
Should the ILIT be purchasing this policy or gifting? What are some of the differences and benefits of each?
Sure. Yeah, happy to discuss that, Greg. So a couple things with this, and if you go to the next slide there, I'll just kind of talk about the ideal situation, and then, situations where we may already have an existing policy looking to get that into trust. So I'll take a look at some of the best practices, and then also some of the challenges of transferring those existing policies into trust. So first, let's take a look at the ideal situation from an estate planning perspective. In the ideal situation, the insured, often the grantor as well, will have no incident of ownership into the policy. This incident of ownership is key for avoidance of estate tax inclusion. Avoiding the incident of ownership is accomplished by having the trust apply for, secure, and be the owner and beneficiary of the insurance policy. In this case, grantor will never have access to the policy, will never have been owner of the policy, won't have access to the cash value of the policy, or control over any decisions regarding the policy. Further, the grantor will make gifts into the trust, with crummy notices being sent to take advantage of the annual gift tax exclusion to pay those premiums. So that's the ideal scenario. The trust applies for it, trust owns it, trust is the owner and beneficiary, no incidents of ownership, crummy notices sent out with any gifts made to pay those premiums outside of the estate, ideal scenario. There may be situations where we have an existing policy, and that can be, a life insurance policy that was purchased many, many years ago before estate tax, taxation became relevant, or particularly it could have been in their situation as well, that they just, came into some money or business did well, and now they have an estate tax issue. A change in health that could prevent the acquisition of new insurance coverage. A birthday coming, very soon, and the trust not being able to be established yet, trying to get advantage of those better pricing. A preferred life insurance carrier has announced an upcoming price increase, feature change, or product restrictions that make it imperative to apply and get that before the trust can actually be completed. So the question then becomes, how do you transfer an existing policy into the trust? And there's really only, if you want to go to the next slide there, there's really only two ways to do this. You can either gift it into the trust, or you can have the trust purchase that particular policy. In the situation of a gift, That can be done very easily through trustee acceptance, affirmative action by the owner of the policy, gifting it into the trust. However, there is a problem under 2035 of the Internal Revenue Code, the so-called 3-year look-back rule. So even if the insured no longer retains ownership because they transferred this into the trust and made an irrevocable gift to do so, if they die within 3 years, the insurance policies will be pulled back into the estate. So the other way to transfer this or get around that 3-year look-back period is to actually sell the policy into the trust. Now, I would say this with a couple caveats. It does have to be a properly structured sale, has to be a bona fide sale for full and adequate consideration, must be a valid purchase agreement in place, and the trust must also have the funds sufficient to purchase the policy. So all of these scenarios are items need to be met in order for an adequate sale to take place. So a lot of times what you'll have is a gift of cash into the policy or into the trust, an agreement to actually purchase the policy from the current owner of the policy and the trustee. Typically, we like to wait at least 30 days to have those funds in there, so it's not viewed as kind of a shell sale. So you'll have the funds sitting in the trust for a while before they actually go back out to purchase that policy. So a lot of caveats to it, but it's certainly a great way to get around that 3-year look-back period. My advice would be to seek, legal advice and make sure that this is have somebody that's done this before to make sure it's properly structured.
Great overview. Another common question, I know a lot of trustees are faced with it. The grantor's just not responding. What are you supposed to do next? Amanda, why don't you take this one?
Sure, thank you, Greg. As Tony mentioned, a large part of trust and policy management is ensuring proper administration on the insurance policies. When contacting grantors, it's essential to identify the information needed and the urgency of that request. Does the policy require immediate funding, or are we trying to confirm, basic information? We understand that people can be hard to reach sometimes, whether it's due to busy schedules, forgetfulness. Some grantors are approaching an older age, and change in contact information, I apologize, approaching an older age may lead to forgetfulness with some of our grantors, so it's important to be cautious of that. And then more often in times we see a change in contact information. Sometimes we only need to communicate on an annual basis, and addresses and phone numbers can change within the last time we spoke. At Life Insurance Trust Company, we recommend exploring 3 options. The first option, contacting the grantor via a variety of ways. We will make multiple phone call attempts when trying to contact the grantor. If an email is on file, we will follow up with an email as well. Number 2, involve beneficiaries. Given the relationship they may have updated contact information. In addition, they may have an answer to our questions or be able to resolve the issue we have. And the third is involving the advisors. Oftentimes, the financial advisors have a very long relationship with the client, and that may be able to provide insight into the situation or be able to guide us on how to get in contact with the grantor or the beneficiaries. In cases where lack of response may impact the insurance policy, our remediation team steps in to explore other options. It's important to document all of our efforts to get into contact with the family. If needed, we'll even send a certified letter, not just to the grantor, but the beneficiaries as well. Being proactive and requesting that everyone's contact information is updated on a regular basis can help avoid any of these issues in the future.
Thanks, Amanda. I know there's really no silver bullet, but these are some good steps to take and certainly, as you mentioned, documenting your attempts is going to be really, really important.
Yes.
Charging appropriate fees. What are other people charging today? And I know we did a survey a few years ago. We can go on to the next slide here, but corporate trustees, we are seeing fee increases all across the board. I mean, gone are the days of taking on an ILIT for $500 or $750. Most of the time, it needs to be part of a larger relationship, a very meaningful relationship for the corporate trustee to even accept that ILIT into trust. And we're even seeing a lot of organizations are having new minimums, where, you know, the policy has to be so big or the relationship has to be so big to even be able to accept that ILIT. 60% of organizations do not believe they're charging enough for the liability created for the ILIT. As mentioned, it's more of an accommodation. They're not charging for that liability. And most of the time when a policy does pay out, it's usually just being paid out to the beneficiaries and the money's gone. I mean, the idea back in the day was to take over the ILIT, manage it, so then those funds would be funded with the organization for ongoing AUM going forward. When we did the survey a few years ago, it was the larger organizations that had a large number of ILITs that were charging higher fees. So when I say higher fees, I mean $2,500 and above. We're seeing some of those organizations now charging upwards of $5,000 per ILIT. Some of the more regional banks, we see ILIT fees anywhere from $1,500 to $2,500. So everybody is trying to get their fees up across the board. Larger ones are going for even larger fees. Smaller organizations, at least trying to get to that $1,500 annual fee mark is what we're seeing them increase their fees to. And we get it. A lot of your ILITs have been grandfathered ILITs. They're still on your lower fee schedule because somebody's afraid to increase their fees or they push back on you. And the reality is, unless it's going to a family member or a trusted relative, there's no other organization that's accepting ILITs at a low fee schedule. They can't just go across the street to another trust organization that's going to take on an ILIT for $500. That does not exist anymore. Next slide. So what's a good ILIT fee schedule? And I know we had a question at the beginning of this, like what should we charge for ILITs? This is just an example of a fee schedule for many different organizations. First thing, consider a setup fee. It's a lot of work to get set up to become appointed as trustee for the ILIT. You know, think about a setup fee, anywhere from maybe $500 to $1,000 setup fee. Annual fees. So we were mentioning that $1,500, anywhere from $1,500 to $3,000 plus, we think would be a healthy annual fee for managing an ILIT. And then, you know, think of some additional fees. If there's multiple policies in one account, maybe you charge an additional fee for each additional policy that's held in that one ILIT. Variable policies. I know Tony's going to get into that. Variable policies have that underlying investment component. So as a fiduciary, you're not only responsible for the performance of the policy, you're responsible for the underlying performance of those underlying investment accounts. And that requires a lot of work and opens up additional liabilities. So having an additional fee for variable life insurance is prudent, and you should be having processes in place to allocate those assets and review them appropriately on an annual basis. A transfer or surrender fee, maybe you have a client that just wants to surrender the policy. We do see several organizations just charging, if it's leaving our organization or going to another trustee, charging that fee, perhaps $1,000 upon that event taking place. And then a termination fee. And what a termination fee, some may call it a distribution fee, but when the death benefit funds, perhaps the insured passes away, the death benefit funds, charging some sort of termination fee, and it could be a percentage of death benefit. And we see anywhere from 1% to 2% termination fee being applied to several organizations across the board. And some might say, you know what, if the money is going right to the beneficiaries, we're going to charge a termination fee. But if 50% or more of those assets are staying with our organization, perhaps you waive the termination fee. But certainly it can all be negotiated with, but just an idea, if you're charging low fees on the front end, you got a lot of liability, you finally get a policy that pays out, it's going to go right to the beneficiary's pockets. It may be prudent to make yourself whole in the back end and charge that termination fee. Additional fees to consider, if you have a client that's paying premiums more frequently than annually, is that 4 gift letters going out versus 1 gift letter? Is that 4 premium payments being paid versus 1? Consider charging an additional fee. At the very minimum, perhaps that will motivate your client to pay fees annually, which will reduce your administrative workload. Large number of beneficiaries. This was from the survey we did a few years ago. Some will charge an additional fee if they have multiple beneficiaries. Let's just say more than 5 or more than 7. Perhaps there's an additional fee per beneficiary. That's just going to be that much more crummy letters, that much more contact information that needs to be updated on your records. So if there's a lot of beneficiaries, maybe there's an additional fee to be charged in that situation. And then, loan servicing fee. You might have clients that want to take a loan out to make a premium payment. Certainly, charge for your efforts and completing the paperwork to take out that loan on those policies. Fiduciary tax return preparation, something that maybe you just pass that fee on to the client, but you just have it in the fee schedule so they're aware of it. And my favorite is really extraordinary fees. Having extraordinary fees in the fee schedule just gives you that flexibility, and perhaps it's an hourly rate of $150 or $200, and then you could apply that accordingly. Maybe you're filling out life settlement paperwork. We know that requires a lot of signatures, indemnification agreements, notarized signatures, a lot of time and effort involved, and just charging yourself some sort of basic hourly fee. I believe it makes a lot of sense, and at least having that in your back pocket on your fee schedule, should you have a situation that's taken a lot more time and effort than you thought, you can charge that fee to make yourself whole for that time spent on that issue. All right, jumping into asset allocation strategies. So this would be for your variable contracts. We see regulators out there. They're looking, are you reviewing the policy? Yes, we are. That's great. Now they're asking for variables. What are you doing for the underlying investment component? Are you consistent on how you're applying these asset allocation recommendations across the board for your policies? We just see more and more regulators digging into the variable investment component to these contracts. So certainly wanted to cover this topic today as well. Tony?
Yeah, thank you, Greg. Appreciate it. Great overview. And, as Greg mentioned, any trustee that takes on ILITs is generally going to run across a variable policy. And also, as Greg mentioned, it really does add an element of complexity to the trustee's duties, as a trustee is ultimately responsible for the investment decisions. And I would go a step further from what Greg even said. Not only are you responsible for those investment decisions, but you have to be able to defend those. You have to be able to say, here's why we did what we did. Here's why it made sense. And even if it didn't work out, we had a prudent process in place where we're protected from our standpoint, and it made sense at the time. Operationally, this can present a lot of issues for ILIT trustees, as every carrier has a different set of investment options, and these may not translate directly to approved investments that your organization may already have. A lot of organizations have approved mutual funds, approved ETFs, approved stocks that they can own. These may not be options, but the trustee's duty to invest these underlying funds must take into account all known circumstances and also an analysis of the underlying investments. We recommend taking into consideration subclass accounts for diversification. These often include large cap, small cap, foreign, diversified emerging markets, bonds. If you are purchasing bonds, what's the duration on those bonds? What are the durations on those mutual funds? Are they government? Are they high yield? Are they inflation protected? Are they intermediate? Are they short term? And then alternative investments. Do you want to seek real estate, natural resources, technology, utilities? A lot of times these can be options as well. And so it's important to look at all of the investment options and subcategories they have. And once you look at those subcategories under those investments, so you may have 4 or 5 large cap funds, you need to differentiate between those. So you're going to have to look at expense ratio, performance, manager tenure, standard deviation, composite percentages. You know, do they actually meet what they say their underlying investment is? Sharpe ratio, beta, all of those things come into play. And then from there, once you have those selected, it's really looking at the asset allocation based on time horizon, funding adequacy, and all other relevant factors available, and finally making those investment decisions. Proper allocation and documentation is something that a lot of trustees miss and can lead to increased liability for these trustees. As Greg mentioned, regulators are coming in, they're wanting to know why you picked the funds you did, not just that they're invested. You know, I'll share an example here. We had an account that came over to us from a former trustee. The policy was around 15 or 17 years old, somewhere in that range. And what happens is when you purchase these policies, a lot of times you'll make an initial investment decision, and you can change those investment decisions at any time. When this policy was initially taken out, they put everything into the money market. The corporate trustee did a great job of sending out premium due notices. The policy was funded on an annual basis for 15 years. However, unfortunately for that trustee, all the funds were invested in the money market. And this was a time where the money market just really wasn't earning anything. If you go back 2 or 3 years, you were lucky to make anything on these. A very quick analysis, you know, with just a 50-50 allocation of stocks and bonds, the cash value, you know, based off our calculations, should have been somewhere in the vicinity of $300,000 to $400,000 higher. That's a big, big mistake of the trustee, and one that they're likely not going to be able to defend. We fixed that when it came over, but it does impact the duration of that policy and a lot of those policy features. So very, very important that these are managed properly. Another story is just, you know, with proper allocation, it really puts trustees at ease during rough market times. You know, you take COVID, you know, we have a process at Life Insurance Trust Company, and we stick to that process. We don't deviate from it. We take all factors into consideration. We document the files. And when COVID hit and a lot of these policies, the cash value in these policies plummeted, we weren't rattled. A lot of corporate trustees were, a lot of clients were, but we weren't, because we have a prudent process that we follow. The other thing that I would mention is, don't overlook the fixed accounts that the carriers often offer on these variable policies. These typically pay around 4 to 5%. There may be times, such as minimally funding of policies, eliminating market risk, where this fixed account can actually be a pretty good option. The key, if you enter that fixed account, is make sure you're having proper documentation as to why you made that decision and why it was a prudent decision. And then I will just put a little plug in here. So our affiliate ITM actually offers an outsourcing solution that assists with these investment decisions for variable policies, and can really eliminate a lot of the risk and come up with a very prudent process and recommendations for these asset allocation.
Thanks, Tony. And that's why I like to call variable life insurance a pain in the asset allocation.
Well, fair enough.
All right, well, I think we got 10 minutes left. We wanted to leave about 10 minutes for questions, so we are right on target. Yes, got a question coming in here. Tony, do most state statute laws allow for bulk transfers of ILITs?
Well, I think that they do. And what we've found, particularly with bulk transfers, is it's really a process that we utilize is really a bulk resignation and bulk acceptance that's ratified through the courts. So even if your state doesn't allow it bulk transfers per se, we do have mechanisms and ways around that, because every state will allow resignation and acceptance, resignation and appointments, which is really what we're doing when we transfer them over here. But every state's a little different. I would say most of them are conforming to the Uniform Trust Code now, so that certainly helps as well. But there's certainly ways around that, even if the state doesn't allow it.
Okay. Thanks for that. Will life insurance trust companies serve as co-trustee?
We certainly can. We have a lot of, I wouldn't say a lot. I mean, we do have a number of those cases where we do serve as co-trustee. We have no issue doing that at all.
Can you discuss the process of what a trust department should have in place when dealing with policies that may require attention or remediation? So you have a problematic policy. What's the process a trust department should have in place to remediate that problematic policy?
Yeah, great question. And I can tell you how we handle it. We actually rate every policy A+ through F, just like the old school rating system. A+ policies, in order to meet that, it's going to meet life expectancy, it's funded adequately. We don't see any real issues that this wouldn't pay out. Conversely, F-rated policies are going to be those that are not adequately funded, may not meet life expectancy, things of that nature. So I think there's a couple things that I would recommend as a trustee. Number one, you're getting updated illustrations on an annual basis to show, is this policy adequately funded or is it not adequately funded? Are we going to have issues down the line or are we fine? And then if the answer to that is no, it's not adequately funded, it's really the trustee's duty to say, okay, we know this isn't adequately funded. What are our options? And you, as trustee, you have to know those options. You have to be able to say, okay, here's the level of funding we need. We can lower the death benefit. We could look at a life settlement. We could look at a policy replacement. All of those are options. And the trustee needs to be aware of all of those options. And in addition to that, they need to relay it to all the parties of the trust. And that's exactly what we do. We outline options available for any problematic policies to the grantor and the beneficiaries. And we work with them to make those decisions.
Yeah, that's a great summary. And certainly it would require a level of life insurance expertise that most organizations don't have in-house.
I would agree. Yeah, you definitely have to know policies inside and out.
Okay. Any other questions? I see one's typing here. Can you discuss trust-to-trust transfer of contracts and trust-to-trust payment of premiums?
Yeah, great question. And, I think some of this depends on the type of trust we're transferring to. So if we have premium dollars or contracts, what type of trust are we transferring to what type of trust? For example, if we have an irrevocable trust that holds a policy, that holds cash, and we're transferring it to another trust, that can be okay. Couple things that I would point out: there can be tax implications from an IRREV trust to another IRREV trust. Can be asset protection issues as well. So anytime you're transferring money from one trust to another trust, particularly an ILIT, there's always a potential for some gift tax issues as well. So you're going to want to be sure you're documenting that, making sure that you're sending out crummy notices, and then just making sure that there's no consequences to that. The same is true with contracts from one trust to another trust. My preferred method, if you have particularly an IRREV trust, is to do a decanting or an amendment to the trust rather than just an outright transfer, just based on some of the issues I mentioned.
Sure, sure. Well, I think we are coming to our end here. I don't see any more questions at this time. So I know we have a lot of clients and industry colleagues on this call. Thank you for your time today. I wish you all a long Memorial Day weekend, and I hope you have a chance to spend it with your family and friends, and enjoy the rest of the week. And thanks again.
Thank you.
Thanks, everyone.
Bye.
Bye-bye.